If you sell your home, the IRS says you can walk away with up to $500,000 in profit, completely tax-free. But most seniors never claim it. They hand over $60,000, $80,000, even six figures to the government because no one involved in the sale tells them the law is on their side. In the next few minutes, I'll show you 4 legal moves that can reduce that bill to zero. Here's who this affects most. Homeowners over 60 selling a house they have owned for decades. Many are sitting on $300,000, $400,000, $500,000 of appreciation. The law says much of that is yours, not the IRS's. But there is a catch. You have to know the rules before you accept an offer. And almost nobody tells you until it is too late. The reason this happens is simple. The people around the transaction are not paid to save you money. Real estate agents are paid when the sale closes. Title companies are paid to transfer the deed, not to give tax advice. And the tax preparer many sellers call after closing is seeing a deal that is already signed, already past the point where planning could have helped. That creates a fatal gap. By the time most homeowners learn what the IRS actually allows, they have accepted an offer. The escrow company has not withheld anything, and the gain is locked into one tax year. The law that should have protected them is called Section 121. It says that if you owned and used your home as your primary residence for at least 2 of the last 5 years, you can exclude up to $250,000 of gain if you are single, or $500,000 if you are married, filing jointly. That is not a loophole. That is a federal exclusion written directly into the tax code. But here is what almost nobody says out loud. The exclusion only helps if you know your true gain, and most sellers calculate that number wrong from the start. They take the sale price, subtract the original purchase price, and assume the rest is taxable profit. That sounds logical, but it is not how federal law defines gain. The actual number is often much lower, sometimes low enough to erase the tax bill completely. So, a senior who thinks they owe $60,000 might actually owe nothing. And if they file without knowing the difference, the IRS will happily accept the larger check. That is the pressure point. The tax system is not built to correct you. It is built to accept what you report. Tax professionals see it constantly. Receipts thrown away, improvements forgotten, forms left blank. Seniors paying capital gains tax on money the government never had a right to touch. The question now is not whether you can legally reduce that bill. It is why so few people ever learn how. The answer starts with a math error that costs older homeowners billions every single year. It starts with a single wrong subtraction. Most sellers take the sale price, subtract the original purchase price, and call the difference profit. But the IRS does not measure profit that way. It measures it against your adjusted basis. That means your original purchase price, plus the closing costs from the day you bought, plus every capital improvement made over the years. A new roof, a kitchen remodel, an addition, a new HVAC system. Those are not small details. They are the difference between a tax bill and a zero. Here is the example that proves how much this matters. A couple bought their home in 1994 for $115,000. Over the next 30 years, they put $110,000 into documented improvements, a roof, a kitchen, an extra bedroom. They sell for $530,000. The naive math says their profit is $415,000. If they walk into the sale without claiming the exclusion and without recovering those improvements, the IRS sees a taxable gain of $415,000. At a 15% capital gains rate, that is a $62,250 bill. But their adjusted basis is not $115,000. It is $225,000. Their true gain is $305,000. For a married couple, that sits entirely inside the $500,000 section, 121 exclusion. The federal bill becomes zero. Same house, same sale. 2 completely different outcomes. The only difference is whether those improvements were recorded. Yet for most seniors, they are not recorded. Receipts are gone. Permits were thrown away. The furnace receipt from 20 years ago is buried in a landfill. So when the sale happens, the IRS only sees the smaller basis. It looks like a sudden windfall, and the government collects on money that was never really profit. But basis is only the first leak. There is a second mistake that happens at the moment of sale itself. Homeowners assume that once a gain crosses the exclusion line, they are stuck. They believe the only option is to accept the full amount in 1 year and hand over 15 or 20% of the leftover gain. So they sign the closing papers, take the lump sum, and create a huge spike in taxable income. That spike is what a CPA could have prevented, because there is a legal tool called an installment sale. It allows you to spread the gain across multiple years instead of absorbing it all at once. In the right case, it keeps your recognized income below the next capital gains threshold and saves more than $15,000. But the most important word is before. Before the contract is signed, before the money arrives, after closing, the option is gone. And if you think that is the only trap, wait until you see how state tax laws turn this whole plan upside down. Some states do not follow the federal rules at all. The list of states that will still demand a check is coming next, and one of them is a surprise that catches retirees constantly. Remember that couple who should have owed 0 federal tax. Now imagine they live in New Jersey. The federal government says the entire gain is excluded. New Jersey says otherwise. It does not conform to the Section 121 exclusion, which means the state can still tax gain that the IRS fully wipes out. And New Jersey is not the only trap. California and New York treat remaining capital gains as ordinary income. That means after you pass the federal exclusion, the leftover gain is not taxed at the lower long-term capital gains rate. It is taxed like wages, which for many sellers means an extra 5 to 9% on top of whatever the federal government took. So the same sale can produce a federal bill of 0 and a state bill of $20,000 or $30,000, depending on where the home sits. Seniors who move across state lines assume their old state no longer matters. But the tax is tied to the location of the property at the time of sale, not where you slept the night before closing. That is the second reason people overpay. They plan around federal law and forget that state law can override the outcome. But there is a fourth tool that changes the entire decision, and it is the one almost no real estate agent will mention because it means the sale never happens. It is called the stepped-up basis rule. If you do not sell and instead leave the home to your heirs, the basis resets to the fair market value on the day you pass away. All the appreciation you built over 30, 40, even 50 years is erased for tax purposes. Take the same house, bought for $115,000, worth $530,000 at the end. If you sell while alive, the gain above the exclusion or the adjusted basis may face tax. But if you leave it to your children, their starting basis becomes $530,000. If they sell at that value, their gain is 0, not reduced, not delayed. 0. That means for some seniors, the biggest tax mistake is selling a home they should have left alone. But it also creates a timing problem. You may need the money now. You may need the care now. You may want to downsize now. The stepped-up basis only works after death, and lawmakers have proposed changing it more than once. So the real question becomes not which tool exists, but which tool fits your exact situation. And that answer changes depending on whether you are selling this year, spreading payments over 5 years, or deciding between a sale and an inheritance. Here is what most people never see coming. The same house can produce 4 completely different tax outcomes, depending on what you do in the next 90 days. Sell without preparation, and the IRS and the state both get paid. Rebuild your basis, and the federal bill drops. Structure the sale as installments, and the rate drops again. Or hold until death, and the gain disappears entirely. The reason seniors keep overpaying is not that the rules are secret. The rules are public. The problem is that nobody in the transaction gets paid to tell you about them until after the mistake is locked into paper. Now, the final piece is execution. There are 4 actions you must take before you accept an offer, and the order matters more than you think. If you do them backwards, you can still lose thousands. Here is exactly what to do, step by step, starting with the one document most people have already thrown away. That document is the receipt. or the canceled check, or the text from the contractor who replaced the roof. Most people throw them away because they look like clutter. But in a tax audit, they are evidence, and the first move is to rebuild them. Start with every improvement made since the day you bought. The addition, the new windows, the driveway, the kitchen, the HVAC system. If the receipt is gone, go to your city or county building department. Permits are public records. They can prove the work existed. That alone can add tens of thousands to your basis and reduce the gain the IRS sees. Second, confirm the 2 of 5 rule. You must have owned and used the home as your primary residence for at least 2 of the last 5 years before the sale. The years do not have to be consecutive, but if you moved out and rented the house for 3 years, you can lose the exclusion completely. Run this test before you list, not after. Third, if your true gain is still above the exclusion, talk to a CPA before you accept any offer. An installment sale can spread the gain over multiple years and keep you in a lower bracket, but only if it is written into the contract. After closing, the choice disappears. Fourth, if you are not sure you need to sell, bring in an estate planning professional. Leaving the home to your heirs can reset the basis to fair market value and erase every dollar of appreciation. That may be worth more than selling now. Here is the part almost nobody tells you until it is too late. You can only use the Section 121 exclusion once every 2 years. Sell another primary home too soon, and the second sale loses the shield entirely. That one mistake has cost more than a few retirees their entire profit. These are not loopholes. They are federal laws written into the tax code. But the system only rewards the people who plan before the papers are signed. The agents and title companies are not going to stop the closing to ask if you remembered the roof receipt. The difference between a $62,000 tax bill and zero is not luck. It is preparation, and the people who get zero are not smarter than everyone else. They just learned the rules before the offer arrived. That is the full picture. Now the real question is what to do next, because the window to act is shorter than most sellers think. The truth is, the tax code is full of doors that close the moment you sign the first page. You do not need to become a tax expert, but you do need to ask one question before every major financial move. Who is getting paid to protect me here? If the answer is no one, that is your signal to slow down. For seniors holding decades of equity, the margin between keeping and losing tens of thousands is not intelligence. It is sequence. It is walking into the sale with receipts instead of regrets. So, whether you are selling this year, planning for heirs, or just starting to organize your records, do not wait for the offer to arrive. If this video saved you or someone you love from an unnecessary tax bill, share it. That is how more people learn the rules before the contract is put in front of them. And if you want to protect what you have built, subscribe to the channel and turn it on. The next video might cover the exact decision you are about to make. Thanks for watching. See you in the next one.